Okay, let's go ahead and finish the final of the number 4 problems. This is a topic that we could spend months talking about, but what I want you to reflect upon the fact that when we do bond valuation is just an extension of the way that we did time value of money, where we talked about reading a problem, documenting the assumptions, and then figuring out what variable of the 5 that we're always using is it that we're trying to solve for. And so you're going to see we're going to just solve for a present value, just like over here when we were solving for present values. It's the exact same process, but the words are just different. So let's look at this together. So let's pretend you have a company and it just sold a bond. The bond promises a total repayment, also known as a face value of $1,000. So put yourself into a bond investor's perspective. What you've just told them is they can expect to get in the future $1,000. When will they get it? It's promised that it will be paid 10 annual periods from now. N per A, just meaning in years. 10. I can expect to receive that $1,000. Now, the current yield on that bond, aka the interest rate, is 2.73%. All right, that is special terminology that you might like to look up called yield to maturity. Yield to maturity is going to be how we determine what the appropriate rate is. Next, why do you buy a bond? Because a bond generally promises to pay you interest. Bonds call that interest a coupon rate. And so in this case, you are promised that you will get paid 3% on an annual basis. So if you just went to a bank and you deposited, for example, $1,000 and you earned 3%, how much would you expect to receive as your payment? $1,000 principal multiplied by your 3% rate says you should expect annual payments of $30. Those things are coming to you then at just like we did with the opportunity cost of capital and the capital asset pricing model. This investor expects a 2.73 rate of return when they're getting actually a 3% payment. So, how much should someone be willing to pay to get $1,000 in the future, to get $30 a year every year when you get those payments for 10 years, and each and every year along the way you get $30? What is your collective willingness to buy that? So if, just like in our previous section with present value, future value, payments, rates, and numbers of periods, if we use this present value because we've identified how much would I pay right now for these future cash flows when I could earn 2.73% doing something else, but I instead am considering getting 10 years worth of $30 payments, and then I expect to get $1,000 in the future. What that suggests is that the current price of this bond, I'd be willing to pay up to $1,023.55. Would you pay a penny? Sure. If you're going to give me $1,000 in 10 years and $30, of course I'll give you a penny. Would you give me a dollar? Yeah, if I would happily pay a dollar if you give me $1,000 in 10 years and pay me $30 along the way? Would I be willing to pay $5,000 if you're going to give me $1,000 in 10 years and $30 a year for 10 years? No way would I give you $5,000. I would be willing, however, to give you up to $1,023.55. That's the price then. So then the next thing that is often discussed is what we call the bond's current coupon yield. So if again we just came out and we looked at like bond coupon yield, oops, you got to spell it right though, coupon yield. The simplest way to calculate a bond coupon yield is to divide its coupon payment by the face value of the bond. Hey, that's not right. It's not its coupon payment divided by the face value. That should say price. Huh. All right, well, I'll show you the formula here. I found an error in the internet. Can you believe it? The internet's sometimes wrong. The current yield is equal to the coupon payment. They were right there. Coupon payment divided by the current price, not by the face value. So let's watch here. If I take this coupon payment of $30 and then divide it by the price, watch what's going to happen. It comes out as a negative again. Why? Because Excel does this weird quirky thing where it says you must give out now, present value, to get these things in the future. But we're switching to algebra here. So when we switch to algebra, we're going to switch the sign on our price, B7, just like I did in that last problem. So I put a minus sign there, and then that tells me that the bond's current yield is 2.93%. That's the amount of return I would get if I just look on the coupon. But if I wanted to, I could buy this bond for up to $1,023.35, and then for the next 10 years, I'm locked in to an investment that will pay me $30 a year, right up until, at the very end, it pays me its final $1,000.